So good morning. I want to welcome everybody to today's mini conference on inequality in life and death, policy and prospect. So I'm Will Dow. I'm the interim dean of the School of Public Health and also the director of the Center on the Economics and Demography of Aging here at UC Berkeley. The center is sponsored by the National Institutes of Health to be an umbrella organization on campus to convene people and to support research on areas trying to understand those life course and social factors which are shaping the health of adults and affecting both the sort of economic prospects and the sort of health and mortality of adults throughout the life course and into aging. So we're really thrilled to have with us today a very distinguished set of speakers, including our keynote speaker, Peter Orszag. Peter will be introduced in a moment by Alan Auerbach, but I just want to say a few thank yous at the outset of the day. First of all, to Alan. It's a distinguished economist in the economics department here at Berkeley, and also the Birch Center, which is co-sponsoring this event with CETA. I want to thank the Berkeley Opportunity Lab and the Berkeley Institute for Research on Labor and Employment that are also sponsoring this event, as well as the Citrus and the Banatao Center for making available this sort of wonderful facility to us. And finally, I just want to thank the staff who have put in the work to organize this event. And these events, they take months and months of behind-the-scenes work to put together. So in particular, I want to thank Elizabeth Vasile for the work that she's been doing. Elizabeth is the executive director of CETA. And if you have any research ideas in the space of the economics and demography of aging, our CETA Center does have pilot grants available to faculty. So please contact Elizabeth or myself if you would like to discuss the potential funding for pilot research, or if you have ideas for other speakers or sort of mini conferences such as this. We have funds available to bring folks to campus to convene people. So without further ado, I would ask Alan to please come on up. So thank you.
Thanks very much, Will. Let me start by also thanking Camille Fernandez of the Birch Center for helping to organize this event as well. The motivation for having this event, in part, was because we had the opportunity to have Peter on campus, and inequality is something that he's been interested in, but also because there's a lot of research going on around here about inequality. And I think the title of this conference emphasizes that inequality is something that, while we tend to think of inequality in a fairly narrow dimension of relating to income inequality, is really a broader idea. And inequality exists with respect to life expectancy as well as during life. And there are many interesting research questions that relate to inequality, including how one measures it, what the policy implications are of changing life expectancy, how well government policy currently works at addressing inequality, and what alternative government policies might be useful. So these are all things that we're going to be talking about, both in Peter's initial comments as well as in the presentations by our four distinguished faculty members that follow. So let me start by introducing Peter and then turning the floor over to him. I'm very pleased to say that Peter is someone I've had the opportunity to write with in the past, although that didn't keep him from moving on to better things. Peter is now the head of North American M&A and vice chairman of investment banking at Lazard. And he previously was vice chairman at Citigroup. He's made important contributions in public policy, serving first as the director of the Congressional Budget Office from 2007 to the end of 2008, And then at the beginning of the Obama administration, he was the first director of the Office of Management and Budget in a very exciting time, from 2009 to 2010, during which I certainly, from my observation, saw him playing a key role in some of the policy initiatives of the Obama administration during that period, notably the policy responses to the global financial crisis and the promulgation and passage of the Affordable Care Act, two very important aspects of economic policy during the Obama administration. Now, of particular relevance today is Peter's interest in work relating to inequality. He wrote a often cited paper with Jason Furman, who was also a member of the Obama administration, dealing with the role of competition, declining competition as a potential source of economic inequality in the U.S. And in terms of his Berkeley connection, he co-chaired a National Academy panel with Ron Lee, who was also on our program, that was focused on the implications of another aspect of inequality, which Ron is going to be talking about in his comments, which came out in a book entitled The Growing Gap in Life Expectancy by Income, Implications for Federal Programs and Policy Responses, which focused on an issue which has since then become very prominent in public policy discussions, the increasing gap in both health and mortality across the income distribution. A very important development in itself, and also one that has important policy implications. Anyway, I look forward very much to Peter's comments, and therefore I'm happy to turn the floor over to him at this point.
Thank you, Alan. I am delighted to be with everyone. Well, okay, so 3 topics. By the way, the most important affiliation was left off because I spent, I think, 2 or 3 years teaching in Evans Hall, Econ 100B. For the rest of my life, will have a fear of fire alarms being set in the middle of exams and what one does about that. So thank you, Berkeley, for teaching me the real important things in life. I'm going to talk about 3 things. The first is touch a little bit on this mortality differential that Ron will talk about in more detail in his discussion. Some of the associated consequences for our politics and the polarization of the American public. Then a little bit on growing gaps between public and private universities and the consequences of that. And then end on the topic that Jason Furman and I had highlighted, which is this growing dispersion in performance across firms and the implications of that, both for inequality and, frankly, for macroeconomic performance. So let's start on, I'll skip the summary, start on life expectancy. So the stylized fact is life expectancy has been increasing on average pretty much at every age. On the left, you see actually now a dated photo. I guess I can't even say average life expectancy has been increasing because in the past 3 years, it hasn't been. In fact, there was a new CDC report out yesterday showing a very slight decline again in 2017. And you can see the leading edge of that at the very right-hand side of this graph. So I should say average life expectancy over a long period of time has been increasing, but not over the past few years. And that's reflecting, in turn, a development that is the highlight of the work with Ron, and Alan was on that National Academies panel also, which is that this growing differential in mortality rates by income or education. It pretty much doesn't matter how you take the socioeconomic status measure of trying to do this analysis. On the left, you see some numbers that Ron may talk about in more detail that just separated the population by lifetime earnings as measured by Social Security earnings. separated them into quintiles and looked at life expectancy at age 50. And what you can see is at the bottom quintile between birth year 1980 and birth year 2010, a slight decline. And at the top, very significant increases in life expectancy, conditional on reaching age 50. And the result of all these things, which Chetty et al. Have highlighted, is just a dramatic gap in life expectancy at birth, depending on where you are born in the household income distribution. I think it's not implausible, it's always a little risky to say this, but it's not implausible to say that a daughter born to a high income family today has a 50-50 shot of living even to age 100, given how rapidly the mortality differentials have been diverging. Ron will talk more about this, so I'm going to just touch on it briefly. One obvious consequence of differential life expectancy is that anything that is annuity-based is going to grow more unequal on a lifetime basis because higher earners are increasingly living longer than everyone else. And so you're seeing very substantial implications for the lifetime distributional consequences of our major entitlement programs, Social Security, Medicare, Medicaid, supplemental security income, which we tried to capture in a present value measure at age 50. And again, you can see these are not small effects. So, conditional on the life expectancy distribution for those born in 1930 versus those born in 1960, a change of $130,000 in present value in terms of the benefits that these programs are delivering. And again, I'm just going to briefly mention that because I think Ron will talk more about it. I'm going to skip this altogether because Ron will talk about that. So thank you, Ron, for covering those parts. I want to delve a little bit more into the drivers and the consequences, though, of these shifts. One thing we didn't pay that much attention to, we noted it but did not delve deeply into in the report, is the very clear racial kind of dimension to these life expectancy differentials. That was true in the CDC report that just came out for last year, and it's true over a longer period of time, which is there is a lot of what's going on here is very specific to the white population in particular. And so here you see white non-Hispanic males having just a dramatically different mortality experience than other subparts of the population. And what's interesting is, although in the most recent data, African American males also had a slight decline in life expectancy. In general, while the gap by income has been going up and the gap by education has been going up, the black-white differential has actually been narrowing. Again, highlighting that a lot of this issue is isolated in the white population. And I think that's feeding into some of the political trends that we're also seeing. But before I get to that, I want to touch on what might be driving this. Because we struggled in the National Academy panel to identify quantitatively what could possibly explain this growing gap in mortality by socioeconomic status. And the observable factors, the fact that smoking has collapsed at the top of the income distribution, come down much less rapidly at the bottom of the income distribution, et cetera, that you can identify, only adds up to, you can pick your number, but let's say a quarter to a third of this mortality differential in terms of being able to explain it. So there's a massive unknown component to what's been happening. And I think, although now I'm going beyond what the panel itself was able to kind of reach agreement on because this is speculative, I think it's becoming increasingly clear that a lot of this has to do with prolonged exposure to stress and socioeconomic sort of perceived status and the implications of that for your health. So a couple kind of indicators of that I think are interesting. One is, this is from Carol Graham at Brookings. If you look on the upper left, the people who are experiencing stress on a daily basis, a couple components of this. One is, not surprisingly, there tends to be at least a little bit of a income distributional effect to that low-income people on average are experiencing somewhat higher stress levels than at least the highest income people. The second point is that there is a significant difference between the United States and even Latin American countries. So basically at every point in the distribution, the US citizens are experiencing higher stress on the previous day than those in Latin America. Third point is that the gradient between high income and low income is actually slightly narrower for the Latin American countries than for the United States. And I think the most important point is the type of stress that's being experienced is dramatically different for low income people than for high income people. My day could be stressful because my flight is delayed, or I missed the conference call or what have you. That has much different health implications than being told you must show up for work at 2 a.m. with very little notice and you don't have childcare, which is a more common form of stress in the bottom quintile or decile. On the right, this is very interesting, and again, it comes back to the racial dimension here. This is a survey about the degree of optimism you have about the future. And what's fascinating about that is in today's, according to today's surveys, low-income African Americans have more optimism about the future than even middle or high-income whites, which is, I think, an indication, and again, consistent with what's been happening to the relative mortality trends. So there's something very specific that's happening to white Americans that is showing up in mortality, and I think it's then also showing up in our politics, which I want to touch upon briefly, because this growing gap in life expectancy, especially for low and moderate income white Americans, is also one of the key drivers in this growing polarization that we're seeing across the political spectrum. So you can see on the top bank, this, the middle is disappearing in our political views. You can see in the middle bank that there's a growing antipathy for people who are of a different party than you are. The share of Democrats and Republicans who view the other people from the other party unfavorably rising rapidly. That shows up even in the share of parents who say that they would be quite upset or displeased if a child married out of the party. You see very low levels in the 1960s rising to, in fact, if we updated that since 2010, it's now over half for both parties. Similarly, if you ask about, are members of the other party intelligent or selfish, you see these just dramatic changes over time where basically if you're not in the right camp, you're both dumb and selfish. Much more so than was the case 40 or 50 years ago, reflecting another dimension of this political polarization. And then finally, there's this new book out called Pickup or Prius, and it looks at different mindsets of the world. So is the world a dangerous place in which we have to protect the existing order and have a lot of rules? That's kind of what's termed the fixed perspective. Or is it a fluid place in which generally it's kind of a welcoming place, there are changing norms, and we've got to adapt? And you can actually measure these things by asking questions like, would you like your child, what's the most important thing for your child to reflect? Respect for elders, abiding by the rules. There are four questions. Very clear changes that have happened in politics, basically, that roughly half of the American population is of either mindset over time, but you've had this dramatic sorting between ideology and political party, where basically at this point, if you're a fluid mindset person, you're extremely likely to be a Democrat, and if you're a fixed mindset person, you're extremely likely to be a Republican. And again, I think this feeds back to many of the same stresses that are driving the life expectancy differentials that I started with. That polarization of the population is then getting reflected in our congressional bodies. So this is fascinating. If you look at, these are distances, the red dots are Republicans, the blue dots are Democrats, basically differences in voting patterns. And you can see in the late 60s, there were clearly two parties, but there was plenty of overlap where the most liberal Republican and the most conservative Democrat were actually closer to one another than the most conservative Democrat was to the most liberal Democrat. And now they're basically just two blobs with no interaction at all. And that makes legislating, the reason I mentioned this is I think, again, it's not only a consequence of many of the same trends, but it is an impediment to policy interventions that may help to offset or address some of the underlying drivers of what we saw on the mortality front. And then as a segue to my second topic, we've also seen this just dramatic change in how people of the two parties view education, and higher education in particular. So question asks, basically, do colleges have a positive or negative effect on the country? And you can see that in even as recently as 2010, there wasn't that big of a difference between the two parties. As this polarization has continued and the frankly anti-elite perspective of I'm frustrated, my life expectancy is not increasing, that we saw perhaps reflected in some of the mortality trends, also showing up in views about higher education, with a fairly substantial change for those who are Republicans in terms of viewing colleges positively, a very significant increase for them viewing them negatively. I suspect that that's going to continue as this polarization continues. And before I turn to the higher education piece that I want to talk about, I would just note we have been through periods of extreme polarization before, and we've depolarized. There are two differences today than the previous, you can see that on the bottom, than the previous periods of polarization. One is the technological environment is different, and it is easier to surround yourself with like-minded people, especially virtually today, than it was 100 or 200 years ago. And the second thing is, in general, we have not depolarized, including if you went back to earlier cycles, outside of cataclysmic events. So a Great Depression, World War can depolarize a country. It's not clear that we can peacefully depolarize without a kind of catastrophic event driving it, especially given the technology changes that we have been experiencing. So I think this is the new normal, and we're going to be in this situation for a while. So with that, let me turn to higher education for a second. It is important to focus on public higher education, not only because I'm at Berkeley, but also because on the right, the vast majority of students in the United States who attend higher education attend a public university or college. And on the left, the research suggests that public universities and colleges play a particularly important role in upward mobility for low and moderate income kids. I'd also just note, as an additional kind of connective tissue between these two sections, that one of the consequences of this growing gap in life expectancy is that, to the extent there's at least a partial causal driver from education to mortality, it's often hard to work out the causality because it goes in both directions. But to the extent there's a pure effect of additional education on mortality, which is possible, and given these increasing gaps in mortality, the conventional return to college estimates are actually underestimated because they're typically done cross-sectionally, not taking into account the fact that you're also getting additional years of life as a result. And so the return to education could actually be significantly higher than the conventional estimate suggests, because it doesn't incorporate this time dimension in it. So public higher education, obviously important. What's been happening? Declining support from state governments. This is relative to income, but you can do this in a variety of different ways. So over the past 35 to 40 years, you've seen declining state appropriations for higher education. The result of that has been that public universities have had to lean more on tuition than previously. But one little told story that Tom Kane and I tried to emphasize about a decade ago is that this has not been sufficient to offset the state of higher appropriations. And by the way, that's not surprising because historically state appropriations were 2 to 3 times as important to public universities as tuition. And so if you cut state appropriations by 20%, you'd have to raise tuition 40, 60, 90, whatever to offset it. And that's just politically difficult. So despite the significant tuition increases, in general, they have not been sufficient to offset the lower state appropriations. So what's been driving the lower state appropriations? The research that I did with Tom Kane suggested, and this is just a time series, but we have more formal econometrics behind it, suggested a key driver was rising healthcare costs in state budgets, which basically crowded out state appropriations for higher education. So ironically, and perhaps this may not be obvious, but in effect, rising healthcare costs are a key driver of the higher tuition at public universities, and that's a connection that may not be obvious at first glance. But as I mentioned, there's a whole variety of ways in which you can measure these things, but the tuition increases basically just have not been sufficient to offset the appropriations cutbacks. And so you see lots of different dimensions of this. If you compare public and private universities in general, the teaching load, or you could do this in a variety of different ways, but the students per faculty member have come down a bit at public universities. They've come down much more dramatically, especially on a relative basis at private universities. If you look at starting assistant professor salaries at comparable public and private universities, 30 years ago, they tended to be close to parity. Now there's often a 15 or 20% differential between public and private universities that are in the same kind of local market. And so it's showing up in a whole variety of different ways. And this is important, as I mentioned earlier, because there is a significant kind of upward mobility component to higher education, and so it ties back into the point about income inequality and mortality that we talked about a little bit earlier. Another phenomenon, this is not specific to public and private, is that we've basically seen a splintering of higher education itself, with schools that were selective before becoming increasingly more selective, and schools that were selective before increasingly having a lot more resources per student than other schools, which is on the right. All of which, again, suggests a kind of splintering in the higher education market that mirrors the splintering in income, education, and mortality. And then the final thing I'm going to say about this is that I put up this chart mostly as a reminder that we still have a lot of work to do in terms of one of the common responses to anything that involves inequality trends is, oh, we're an equal opportunity society, and so it's all about opportunity, and you're just looking at outcomes and not at the opportunity that's being provided. That's not fair. So if you want, I think, the deepest indictment of that perspective, these kinds of studies suggest that if you look at 8th grade test scores, and so high ability students in 8th grade who come from low income families, left side light blue bar, they are completing college at only about the same rate, 30%, as the lowest aptitude students from high income families. So in an equal opportunity society, that just should not happen. And it's not like there aren't lots of high ability, low income kids out there. We know from a variety of research that there are significant opportunities to basically try to pull more high ability, low income kids into more of the selective schools. And this is, I think, another disturbing piece of research, which admittedly higher education is responding to. So the situation is getting better. But this shows you basically where college applicants are applying to. And basically, the further you go to the left, the more that you're sort of underselling yourself for your own scores relative to the median of the school you're at. And you can see that the low-income kids, who are the blue distribution, tend to undersell themselves much more than high-income kids. That also, though, provides a channel for doing better. And I would say higher education is doing better at trying to seek out those kids who are high ability, low income, who just might not know that they can go to a place like Berkeley or Stanford or what have you, and not have the full financial costs that they might believe is the case be an impediment. Want to just end on, final topic, on another dimension of this increasing dispersion that we're seeing in our economy, and focus on the role of the firm, and then I want to leave plenty of time for questions too. So in a lot of economics, the firm is treated, let's just be frank, as sort of an annoying intermediary that it would be better just to kind of wave our hands and be done with. So a lot of economic theory looks at firms as if they are inconsequential, and it doesn't really affect either the macroeconomy or what happens at the individual level. So all that really matters is, the underlying tax rate, your education, and what have you. Or at the macro level, all that really matters is, the Fed policy or the degree of stimulus and what have you. And we miss this kind of intermediate layer of what's happening at the firm level. And I think that is becoming an increasingly problematic thing to do, because what we're seeing is that what happens at the level of the firm really matters for a whole lot of outcomes. So I'll give you a couple examples. One, we're seeing this dramatic concern around the fact that productivity growth is much lower than it was a decade ago, and certainly much lower than it was in the 60s and 70s, or let alone the 50s. And yet, productivity growth actually has not slowed down at the frontier firms in each sector. So you're seeing this increasing gap between the firm that is kind of the leading firm in each sector and and everyone else. And that's kind of odd in today's world, because you would think that anything that the frontier firm is doing could spill over in the age of Twitter and social media and whatever to the other firms, and yet that's not happening. It also suggests that explanations for the productivity slowdown that are exclusively based on the tax regime or the policy environment or whatever probably also have something that is missing, because those frontier firms are subject to the same those same rules and that same environment, the same landscape as the other firms, and yet for them, productivity growth has not actually slowed down. We're also similarly seeing in financial performance a kind of analog to the graphs that we've all gotten used to on income inequality, which is that inequality across firms in performance has just exploded. So this is the return on invested capital, which is a measure that abstracts from the debt equity mix that a firm might use to finance itself. And what you see is, if you rank all publicly traded firms in each year by their return on invested capital, the 90th percentile has just exploded relative to the median or the 25th percentile or the 10th percentile. There's something happening at the leading firms that is not happening to the other firms. One dimension of that is they tend to be investing a lot more in intangible capital. So things like research and development, things that are counted as an investment, but that are not physical things that you can touch. But nonetheless, regardless of what the vector is for their accomplishing this, you're seeing this massive dispersion in firm performance from an investment perspective. What happens at the firm is also important, because most of the narrative for inequality in earnings and income in the United States is typically a sort of, it's the CEOs are earning a lot more and the typical worker at a firm is not. So the whole problem is that the executive teams are extracting lots of benefits and no one else is. And if that were right, then what you would expect is that when you looked across firms, inequality would be rising dramatically within firms, but there would be very little shift between firms. So the between component of variance decomposition would be small, and the within firm component would be quite large. And what you see instead is actually that's not what's happening. That I'll show you a couple studies of this, and I'm going to come to caveats in a second, but the bulk of the rise in wage inequality in the United States over the past couple decades has been between firms, not within firms. So, and I'll get to the caveats in a second, it's a little bit less that the CEO at Apple is earning so much more than the median at Apple, and it's a little bit more that everyone at Apple is doing better than everyone at Applebee's. And that's a different thing. That's suggesting we've got to be focusing on why is this, what is happening across different types of firms that provides a much different narrative for even things like wage inequality. Now, there are some caveats, but before I get to that, there have been a couple of different studies that I won't dwell on, but that show a similar thing. So, and also show, by the way, if you are a middle income worker, it is far better to be at one of these top firms than at a typical firm. In other words, the famous advice that Sheryl Sandberg got at one point, which was, if you're offered a ride on a rocket ship, get on. Don't ask what seat you're sitting in. Seems basically to be true, because basically if you're a middle income worker on the right, you do a lot better at a top paying firm kind of at this frontier than you do at other firms. This again suggests that what's happening at the firm level really matters, because this sort of phenomenon, just if you're offered a seat on a rocket ship, get on, is completely missing from most of economic theory and most of the economics that's taught to undergraduates today. So the caveats here, it is always a concern that when we look at publicly traded data, that the number of firms that are publicly traded has been declining significantly. That does not seem to be the sole explanation for the divergence in publicly traded corporate performance. There's also a concern that maybe some of the between firm variance is because workers who would have been classified as employees previously are now working for, so think, the janitors used to be employees, and now it's a janitor company that is being hired to do that work. It's the same work. The experience for the workers is similar, but that shows up as between firm variance because they're no longer employees. There seems to be some of that, but again, I don't think it explains the bulk of what's been happening here. And so my conclusion has just been we should be paying a lot more attention to why is it that some firms are doing a lot better than other firms in today's environment, where I would have thought, again, in a world in which it's easy to share what different companies are doing. There's much more information about management practices, which I'll get to in a second. Why are these differences across firms persisting? And they seem to be quite significant. I'm going to skip this for a second. Let me just end on this. So this was a study that Nick Bloom and others did using a census survey of management practices at different firms. I've always been quite skeptical of management consultants, but it sort of caused me to pause and think they may be actually onto something, that maybe part of what's driving these big differences across firms has to do with how the firms are, the sort of organizational capital within the firm. Because what they show is basically some pretty simple differences in management techniques explain significant differences across firms in productivity and operating profit. And these, again, are not sort of rocket science types of management practices. It's, effectively things like, do the boss's kids get to become the boss? Or do you have annual reviews of performance at the individual employee level? And even fairly simple metrics that measure whether the management of the firm is kind of performance-oriented seems to be associated with fairly significant differences in how well the firms are doing. And again, I mention this only because no one here would really care that much if all that was going on is those firms were doing better. But again, these differences seem to be associated with the welfare of the workers also at those firms if a significant part of the rise in inequality has to do with between firm variance. So let me just close by saying on this part, there's a lot of discussion about what do we do about this, and before we can really answer the question of what do we do about this, we need to know what's driving it. And I just put up a couple different possibilities. One is this organizational capital sort of management technique that I just mentioned. The worker sorting is another one that workers are sorting into different firms. That's showing up in between firm inequality. It has different consequences than if that were not happening. Another clear possibility is that there's just consolidation, and there always have been rents that have been strewn throughout the economy, but they're now being concentrated in particular firms, and whether antitrust enforcement has been sufficiently aggressive to combat that. And then the final one is that in a lot of these markets, there is a either a network effect or some kind of winner-take-all phenomenon that happens at the firm level. And if you happen to be at one of those firms, you're going to share in some of those benefits. But I feel like one of the key things that the academic community really needs to take on is, why is this happening? Because there's a whole variety of important policy dimensions that feed back then into other dimensions of inequality that we don't really have a great basis for acting upon yet, because we're still very early in the research on what's driving all of this. So just to summarize again, massive and growing gaps in life expectancy by income and education, some growing gaps between public and private universities that seem to be driven by what's been happening to state appropriations in particular. And then I think the most fascinating new development over the past 5 or 10 years is this growing dispersion in firm level performance and what's been driving that. And again, thank you for having me, and I think we have a little bit of time for questions, so thank you. Questions?
Let me to get the pump primed.
Okay.
Let me ask you one. So on the last issue, where you're thinking about the causes of this greater heterogeneity in firm performance, and as you pointed out, there are quite different policy implications if it's caused by concentration of rents and reduced competition, as opposed to globalization and network effects, which basically says a changing nature of technology and sort of the opportunity for the very best firms to take advantage of much larger markets than was true in the past. It's obvious that if it's the first story, there are clear public policy responses suggested, as you suggested, a change in competition policy, for example. But consider the second case. Suppose it's markets working well, but the nature of markets has changed. So we have fewer trade barriers. What we're trading doesn't weigh as much, so the trade in services is a lot easier than trading coal and steel. So all of this is happening, and it's making the high-tech companies that dominate not just the U.S. economy, but the world economy much more successful. And then the smaller, less successful versions of these companies just operate in the U.S. and don't do very well. I think the classic public finance response to this is let markets work well and just improve redistribution. Have a stronger social safety net and so forth. I think if to get to your politics, that wouldn't be the answer that those people want. They want to go back to something. They want to have meaningful employment. They don't want to be told that they're going to get a bigger transfer payment. Do you have any thoughts on that as a barrier to the potential, sort of the classic response?
Well, I think there are a couple there are a couple things before we get to the responses. Just on the whether that's the sort of whole explanation. You can tell us there are a couple other things I didn't talk about that might inform, sort of where we are on this spectrum. So, for example, firm-to-firm mobility, or despite all the hoopla about job tenures going down and more worker churn, actually worker mobility has gone down, not up, and that you could possibly link to it all being kind of a kind of winner-take-all market, that the insiders at those firms, are going to be reluctant to have people moving, but it at least raises some question of why is that happening. Similarly, another phenomenon that's occurred is we've seen not only declining new business entry, but also more a decline in the exit rate. So zombie firms in the United States are actually more likely to survive today than was the case 30 years ago. That's a little incompatible with just let the market roar and everything's going to be fine. But let's move past that and say, okay, let's say the only reason that the frontier firms are doing better than other firms, it's not that they're managed better, it's just that technology has changed. The optimal size of the firm has gone up because it's a network effect and it's easier to manage people with new technologies. What do you do about it? And I think the answer is the one that you mentioned, which is most of the policy interventions then kind of are not workable except the kind of tax and transfer approach. But it also does raise the question of their own policies. I'm not saying the policy world should enforce this, but whether the companies themselves start to distribute those amazing insider jobs in a broader array of places. And that's what's interesting about this new Amazon thing, where they're opening up I don't really know what it means to have 3 headquarters. I mean, at that point, you could have 20 headquarters. But what's fascinating about that is they're, not surprisingly, opening them in places that are already doing well. And so one of the other dimensions that I didn't talk about is this growing gap across the sort of leading urban centers of the United States and sort of everywhere else. So one vector here you could imagine is that those places will be pressured to be opening opportunities for others to participate in their rocket ships on a more distributed basis. It's again not in their own self-interest right now, so I don't have a full answer, because I think fundamentally if that's the driver, then you're not really offering much hope to the people who are frustrated and seeing lower life expectancy, other than other than taxing them and transferring money to them. But that, if you go out and ask people what they want, that's not what they want. They want a good paying job. So I unfortunately don't have it. And the other ones are easier, especially, look, I think there's a lot of people especially in the Democratic Party, who are kind of hoping that this third thing is the real driver here, because then at least you know what to do. Right. Then we need to reinvent the antitrust rules, and that's difficult. There's a lot of trade-offs and what have you, but at least you know what to do. If it's instead that workers are sorting themselves, or some management teams are just better than others, which actually, here's another point. To the extent the first one is true, there's tension between the first and the third one, because to the extent the first one is true, you actually want those amazing management teams managing more stuff. And so there's an argument for more consolidation, because if they're doing something better and they're scaled to expand what they're doing within the 4 walls of that firm, you want that to happen.
I want to ask a similar question on the health and stress and mortality and equality. What are you seeing as the intervention? Is it everything else, or is there some specific? We could debate about the causal effects of stress, but let's say that's the cause. What are you thinking there?
It comes back to the same answer, which is, what are you offering to the 45 or 50-year-old white male at the 25th percentile of the income distribution, in Ohio? And I don't have a magic bullet here. I do think there's been a lot of false promises that have been made recently to that person who just wants to believe that we can, that they're simple solutions. I don't think there are simple solutions. So I don't have a full answer. It's frustrating to me. I think we'd love to have a full answer, but I think part of the answer, frankly, is not over-promising, because I fear that the biggest, it's not the biggest risk, but a significant risk is laying out these false promises that it'll be easy to undo something that's been building up for decades, and then, not surprisingly, people get even more angry when it's already not good. You promise a solution, it sounds good, and then that doesn't work. So, there are all the obvious things that are cliched at this point: better education, all of that is fine. All of that takes time, and I guess my biggest concern would be to suggest we can kind of help a bit but not fully solve the problem, because I don't know what the full solution is. And I think there's a big risk of the temptation of looking for that, and I understand in politics that's important, but when it's false, and it will ultimately boomerang in a very negative way.
Well, maybe this is along the same lines, a little more directed hypothetical.
Okay.
If the U.S. Medical care expenses were 10% of GDP instead of almost 20%, wouldn't that allow for a vast amount of investment income in directions that might significantly diminish the stress expectations you were so eloquent about earlier, and lead to changes, for instance, in life expectancy metrics, perhaps more than any direct investment in quote-unquote public health?
Yeah, so one of the reasons why I've spent so much of my time focused on wringing out what by any standard is substantial inefficiencies in healthcare, it is by far the largest opportunity we have. So economists will often talk about the distortions. Alan's one of the leading scholars on this. The distortions from high marginal tax rates, and they're typically a quarter, a 0.5% of GDP, or even from trade. You get these numbers that are like 0.5% of GDP. I would say it's reasonable to think that we are spending 4 to 5% of GDP on healthcare expenditures that don't actually improve health. So that's 4 or 5% of GDP. It is massively larger than lots of the other things that we talk about. So a couple quick things on that. One, the news is actually somewhat better than is commonly appreciated. So if you look, for example, at Medicare spending per beneficiary continues to decline on an inflation-adjusted basis, which it's been doing now for 8 or 9 years. When I was budget director, if I had stood up and said, I think real per person spending in Medicare will actually fall for 8 or 9 years, a room like this would have laughed at me. That's exactly what's happened. The combination of digitization, which is not sufficient by itself, but is an enabler of more efficient care, and more importantly, the expectation that we are moving away from fee-for-service payment, where you just pay for volume, and guess what? That's what you wind up with, is changing the way healthcare is delivered in the United States, and I'm hopeful that we will continue to kind of squeeze that balloon. But I agree with you, it is by far the biggest opportunity that we have, is that we can do a lot better there, and then yes, we can redirect the resources. I guess what I was saying is I don't know exactly how quickly we're going to be able to do that. I keep pounding, but who knows? And B, exactly the best way of spending what that sort of healthcare dividend would be, that would be directly responsive to this problem, especially because the easiest way of doing it is in the form of transfers, which is not what people want. And so you have to think of more durable other dimensions in which you could improve their economic outlook. That's going to take some time.
Well, unfortunately, we've run out of time. I'd like to thank Peter for giving a very stimulating opening of this conference, and also invite you to have a short break before we return to the rest of the program. Well, let us resume with the balance of our program. So, as I said, when we were thinking about organizing this conference, we thought the subject would be not only interesting, but would give us an opportunity to highlight the research of many of the economists who work here on various aspects of inequality across in the economics department and across other units on campus. And so we have four people working in distinct areas, but all touching on inequality, who are going to be talking. They're all listed on the program. I'll just, let me introduce them all at the beginning so that we can go seamlessly from one speaker to another once we get started. Hopefully have time for a question or two to each speaker in between, and then if we have any time at the end, we'll ask everybody to come up and answer and address questions. So our first speaker is Yuri Gorodnichenko, who's the Quant-Edge Presidential Professor of Economics, who's going to be talking about the distributional effects of monetary policy. Sometimes we don't think about inequality in terms of macroeconomics as opposed to some of the microeconomic issues that Peter was talking about, but it is nonetheless an important consideration. Hilary Hoynes, who's the Professor of Public Policy and Economics in the Haas Distinguished Chair in Economic Disparities and the co-director of the Opportunity Lab, which is one of our co-sponsors today, is going to be talking about how the social safety net reduces inequality. Ron Lee, who is a professor in the graduate school in economics and demography, and for many years the director of CETA, which before Will took over, and who's been a major contributor in the literature on economic demography over the years, talking about how growing inequality in lifespan impacts the progressivity of government programs. And finally, Gabriel Zuckman, who's an assistant professor of economics, is going to talk about interesting work he's been doing recently, developing sort of extending the national income accounting concept to take account of distributional consequences by in what he calls distributional national accounts. So with that, let me invite Yuri to come up and kick off this part of the program.
To be here. Peter set the stage perfectly for me. We know inequality is a big deal. We should care a lot about this. Usually the discussions of inequality are in terms of long-term trends, you know, what inequality used to be in the 60s and the 80s and 2000s. So we kind of take a long-term view of inequality. But there are important business cycle fluctuations in inequality. Some of these are driven potentially by policies, such as monetary policy. And in my brief presentation, I try to provide some evidence and some discussion of how monetary policy specifically can exacerbate or maybe alleviate some of this inequality, since we see in the long-term data. Right? So we all know there is a lot of increase in inequality. It's a big problem, a source of great concern for policymakers, for economists in academia, for general public. What's also became clear very recently during the Great Recession was that many people have a view that, in part, the reason why we have a lot of inequality is because of the policies implemented by the Fed during the Great Recession. You know, one of the big scenes from where the 99% movement at the time was that, you know, the Fed is bailing out the very rich people, they're not helping the regular folks, and so this kind of creates even more inequality than it was before the Great Recession. Now, this was a kind of shock to many policymakers at the Fed and many other central banks, because they didn't think about inequality or distributional aspects of their policies as being something important. For a long time, people saw that policies such as, you know, monetary policy, change in interest rates are going to have roughly uniform effects on population. That is, more or less, poor and rich people are affected by the same magnitudes. But, you know, this kind of movement and, you know, subsequent research started to move this prior into central bankers thinking that this monetary policies and can actually be important for distributional considerations, right? For example, you look at recent, more, I guess, like relatively recent speeches by the Fed chairs, Janet Yellen. She was saying, look, I really care about inequality. It's a big deal. We should think about how our policies can influence this. And this is not just about fiscal policy. It's also about monetary policy. Mark Carney, Bank of England, is saying, again, we have to think about distributional aspects of inequality. It's an important thing. Maybe we make it worse with our policies. Benoit Couret from the ECB, again, is saying inequality is a big challenge, and we have to think about how we can contribute to it. If Mersch, again, from the ECB, is saying, well, maybe the way monetary policy is working is actually through creating inequality in the society. Basically, you redistribute resources from one group of people to another group of people, and this is how monetary policy works. This is the transmission mechanism. That is, you have some policy action, and the economy is going to react to that, and this bridge between the action and the reaction is through redistribution. Okay? So in a way, then, it's a classic question for monetary economists. How does monetary policy work? And historically, there were two views on how this works. One is intertemporal substitution, which means you lower interest rates, you create disincentives for people to save. They consume more today relative to what they will do in the future, and this is how you can stimulate the economy. That's one channel. A more classic view, all Keynesian view, is that it's all operating through income. You give more cash into the pockets of people, they're going to spend more, and this is how we can stimulate the economy. But there is a new view of how monetary policy is operating, and here at the heart of this transmission mechanism is really redistribution. You take resources from group A, give it to group B, and this is potentially generating booms or recessions in the economy. For example, you take money from low MPC, marginal propensity to consume people, give it to high MPC people, and you're going to generate more consumption in the economy. Okay? Now, how this can work theoretically? There are several channels. One is the income composition channel, and this is basically saying we have different types of income in the economy, and they have different sensitivities to changes in interest rates. For example, financial income is going to be very sensitive to changes in interest rates. You have also transfer income, which is not terribly sensitive to changes in interest rates. For example, your disability insurance is not tied to any kind of Fed policy in any shape and form. And to the extent different households rely on different sources of income, you can already create redistribution of income from relative redistribution from one group of people to another group of people. Another possibility is so-called portfolio channel. That is, some groups of people have particular portfolios, and they may be sensitive to changes in interest rates or changes in inflation. For example, we know the poorer people tend to have a lot of cash, which is very bad if you have inflation, and richer people tend to have interest-bearing savings, and so they're much more protected from this inflation stuff. And again, by changing interest rates, by changing inflation, you can redistribute wealth in the economy through this channel. Another possibility is what's called the savings redistribution channel. That is, in every point in time in the economy, we have net savers and net debtors. Like the older people with pension accounts tend to have the net savers. You have young people who have a lot of debt. By changing interest rate, changing inflation, you can move resources from, say, the old people to the young people, or the other way around. And again, to the extent, for example, the young people have high MPCs, high propensities to consume, you can stimulate the economy. Okay? And then another channel, there are many channels, but this is the last one I want to highlight, is what's called the earnest heterogeneity channel. And here the idea is that people have different exposure to recessions and contractions, right? So some people are working in very cyclically sensitive industries. Think about GM, Ford, and so on. This is a very cyclically sensitive industry. Somebody is working in UC Berkeley and completely insulated from business cycle variation. And so then, again, to the extent we have this heterogeneity and exposure to business cycle variations, we can have redistributive effects of monetary policy. Now, if it's true or not, it's a big question in monetary economics. Is it really true that these redistributive channels are quantitatively important in the data? And in the rest of my remarks, I'll try to convince you that this is indeed the case, and these effects are potentially pretty big. And to do this, I will use a very simple statistical framework to convince you that this is the case. First, we need to create sources of variation, right? So say, why we have these changes in monetary policy. And to have this sort of exogenous variation in monetary policy, I'm going to rely on Romer, David and Christie's identification scheme, when you try to identify periods when basically for some unexplained reason the Fed decided to raise or lower interest rates. Okay, so it's not related to the state of the business cycle. That's number one. Number two, to keep econometrics simple, I'm going to use a single equation approach where you have an outcome variable x at some horizon h. You project it on legs of this variable x, and then a bunch of monetary policy shocks. This is this epsilon RR. And then by running this regression at different horizons and collecting coefficients from this regression, you can construct an impulse response. That is, what is the dynamic reaction of the economy to a shock? You have an impulse, a monetary policy shock, and then you want to trace how the economy, this outcome variable x, is responding to it. Now, this framework is very flexible, and you can use basically any outcome variable you want. You can have GDP or some other aggregate statistic, or you can look at inequality and see how inequality is responding to this, so different types of income. Now, when I'm going to use aggregate outcomes, I will use standard national income and product accounts, so this is very standard stuff. And when I talk about inequality, I will use the US Consumer Expenditure Survey. It's not the ideal source of information on inequality, but unfortunately, this is the only source of information which is available to us at high frequencies. Basically, every quarter we know how much people spend and how much income they make. And so then we can construct in a point in time what is the cross-sectional distribution of incomes, cross-sectional distribution of spending, consumption, and so on. And we can see how this cross-sectional dispersion is reacting to the shocks. Now, as a first pass, let me just try to convince you that these shocks actually create meaningful variation in the data. This is the response of GDP, an aggregate measure of economic activity. And what this figure is telling you is that you raise interest rates exogenously by 1 percentage point, and then roughly after 10 quarters, the horizontal axis is in quarters, the aggregate GDP is declining by 1 percentage point. Right? So it's a big effect. Monetary policy can have a huge effect on aggregate outcomes. Now, income is not necessarily the best measure of welfare. Presumably, we should look at consumption and leisure, specifically consumption, because this is something that goes into our utility. This is what drives our welfare. We can also look at consumption. It's going to be very similar. You raise interest rates by 1 percentage points, aggregate consumption is going to decline by 1 percentage point. That's a very big effect. Now, consumption is a composite of many different types of consumption. We have durables, not durables, we have services. The reaction may be different there, and that's exactly what we see in the data. When you look at non-durables, basically say consumption of food, there is very little sensitivity to interest rates, which makes sense. We have to consume a certain amount of food no matter what the Fed is doing. So in this sense, it makes all sense. When we look at durables, cars, refrigerators, this is the bottom left panel, we see big reaction. For services, also a quite significant reaction. Okay. Now, unfortunately, the vertical scale, the vertical axis has different scales, so it's a little hard to read. Let me put this on the same scale so you can compare the magnitude of the responses. The black line is aggregate consumption, the red line is non-durables consumption, the green line is services, and the blue line is durables. And what's clear here is that you raise interest rates and the reaction of durables is going to be much, much, much stronger than, for example, non-durables. Why is this important? Well, it's important because households are very different in the consumption baskets they have. The poor people tend to have a lot more non-durables than durables and services. The rich people have a lot more services and durables. And again, then by changing interest rates, you can kind of incentivize people into changes in their consumption patterns, and this can create changes in the consumption inequality. Okay. Now, if you look at residential investment, basically people purchasing houses, there the reaction is even bigger. And again, to the extent the rich people consume a lot more housing, you should see a lot more redistribution in this market. Now, this is on the consumption side. We can also look at different types of income. I told you different people rely on different sources of income. Wages and salaries, this is the top right panel. Relatively little reaction to changes in interest rates. Transfer income is actually declining in the short run, but then roughly insensitive. On the other hand, when you look at things which presumably should be more sensitive to interest rates, for example, business income, the top left panel, or financial income, we see huge differences in the reaction. right? So you raise interest rates, financial income is increasing a lot. And okay, this is again maybe important for inequality because if you're on a pension, which is indexed somehow to your interest rate income, this is going to be a big deal. If you run a business, economy is deteriorating because the whole economy is declining, contracting. It's going to be bad for your business income. So again, you can see there is a lot of redistribution. Now we see this kind of different components of consumption and different components of income. Now we can put everything together and see how inequality is responding to monetary policy. All right. Now what I show in this slide is the following. I take the survey consumer expenditures. I know income for each household participating in the survey, and I calculate in the cross-section what is the standard deviation of log income in a point in time. Then I move to another wave of the survey and again calculate this cross-sectional standard deviation and move it forward in time and then project this on monetary policy shocks. And this gives us the reaction of this cross-sectional distribution of income in the economy. And what this figure is telling you is that you raise interest rates and it's going to generate more income inequality in the economy. Now, if you extend the horizon, this is 28 quarters. If you extend the horizon, this inequality is going to start to decline, right? So this is just to say monetary policy does not influence the trends, right? So it's a business cycle phenomenon, right? It's not something which is contributing to differences between inequality in the 60s and today. But if you care about elections and your horizon is 4 years, this is potentially important. Okay. Now again, I told you this is income, and it's not necessarily the best measure of welfare. Maybe people have something in their pockets so that they can smooth out this income inequality, and they still enjoy the same levels of consumption, and then it's not a big deal. The beauty of the CEX is that we have a lot of information on spending, and we can again do the same exercise in a point in time, calculate the cross-sectional dispersion of consumption, and then see how this cross-sectional dispersion is responding to an increase in interest rates. And what you see here is that a huge increase in consumption inequality. So this income inequality increase is translated into consumption inequality increase. So it's not innocuous that you create more income inequality and somehow it's neutralized by some type of policy sometime later. We see that it translates into differences in consumption inequality. Now, which tail of the distribution is responding? Maybe it's all driven by the rich people, or maybe it's all driven by the poor people. We can answer this kind of questions by looking at differences between, say, the median guy and the rich guy, the 90th percentile. This is the red line. And you can see this line is increasing, which means the distance between the rich people and the median guy is increasing. So the right tail is moving further away. The blue line is telling us what is the performance of the poor guy, the 10th percentile relative to the median guy. And we see that this line is going down, which means the poor people lose relative to the median guys. So it seems that when we talk about these changes in inequality, two tails of the distribution are active. The poorer people get poorer in relative terms, and the richer people get richer in relative terms. Now, one interesting kind of consideration for monetary policy, at least in recent discussions, is we know that interest rates are very low, and there is a growing concern that if we want to have the Fed to be effective at fighting recessions, they have to have more cushion for changes in interest rates. And the current inflation target of 2% may be too small of a cushion, right? You hit zero lower bound too quickly, and then you can't go below zero, and so you can't fight recessions. And one question is, what will happen with inequality if you raise an inflation target, say from 2% to 4%? And historically, we can construct measures of what was the target of the Fed over time and see how changes in this target contribute to inequality. This is the reaction of consumption to these changes in the target. And the magnitudes are really big, right? So here it's like 0.4, 0.04. This is 0.08, right? So basically have a double of the effect. Now, the reason why it's important is because when we have these discussions about raising the inflation target, we almost never talk about distributional consequences of that. And this is suggesting that, this may be something very important, okay? Something very important. In the end, it seems like there is more and more evidence that monetary policy, which many people saw before, is a completely neutral policy tool. That is, it has the same effect on all cohorts of population. Actually has very strong redistributive effects, okay? Now, this is still a very young research, and there are lots and lots of questions about what actually happens in the data. For example, CEX, the Survey of Consumer Expenditures, does not have Bill Gates there. It doesn't have Larry Ellison and people like that. We don't know what happens with them. And we know these people are very important for aggregate measures of inequality. So maybe ideally we will use some data from the IRS to shed new light on this, but not now. Another question is when we think about counter-cyclical policies implemented by the Fed, say, the Fed is now concerned that the economy is being overheated, they raise interest rates. If you believe these results, this is suggesting that when they raise interest rates, they may contribute to inequality, right? They may raise it, elevate it. Okay, and again, it's usually not something that goes into the discussions at the Fed, but probably they should be thinking about this because politically it creates all sorts of frictions at a later point. And finally, when we talk about, for example, zero lower bound, people did not appreciate that if you are not able to lower interest rates, it may actually be very bad because, for example, you want to have a minus 5% interest rate and instead it's 0. It means that artificially your interest rate is 5 percentage points above what it should be, right? So it's as if you have a contractionary monetary policy at the heat of the crisis, okay? And again, the reason why it's important is because we know recessions are very bad for inequality and this kind of things may exacerbate them. Again, so this is still kind of very young literature, but it seems like we should really think more about this kind of considerations when we care about short-term fluctuations to medium-term fluctuations in inequality. Thank you. Okay.
Okay, we have time for a couple of questions, if anybody has them. Let me start. You talked about the possibility of changing the inflation target. There have been other innovations in monetary policy in recent years, such as quantitative easing, which basically was adopted as a necessity because of the zero lower bound on short-term interest rates. Do you have any sense of what the expanded scope of monetary policy, including not only buying longer-term treasury assets, but getting more directly involved in other asset markets, what the implications of that might be for inequality?
It's a great question. Unfortunately, we have very little data on portfolios of people. But maybe if you work in Lazard and you have information on specific portfolios of people, you can see how changes in interest rates are going to translate on this. And for example, if you hold an asset which is going to be purchased by the Fed, and so then this asset is going to have a higher price, then it obviously has some implications for inequality. Unfortunately, the CEX has very poor information on types of holdings people have, so we don't know if they had something which was eventually purchased by the Fed. But that was one of the key drivers of the 99% movement. They felt that when the Fed is buying stuff, it benefits very narrow groups of people in the economy, very wealthy people, and that was perceived as extremely unfair.
Let me just follow up and then see if anybody else wants to ask a question. So the cut that you've done here is sort of the across the income distribution. But there's another one which you sort of alluded to in talking about different people at different points in the life cycle.
Correct.
And traditionally, when we thought about policies that raise or lower interest rates, there's been sort of the, as you said, the older savers versus the younger dis-savers. Do you have a sense of if you were to do the same kind of analysis, not by income but by age, whether the distributional effects would be bigger or smaller than they are by income?
Yes, so we did something like this in a related paper, and as you said, this is exactly what we see. If you look at older people on average, they tend to have much bigger net wealth than younger people, and there you can see very big redistributive effects, and kind of makes sense because the older people rely a lot more on interest income than the young people. And you can clearly see that you take away resources. When you lower interest rates, you take away resources from the old people and give it to the young people.
Rich? We want you to be preserved for posterity.
We need to be wired. So a contractionary shock, like a higher interest rate, exacerbates income inequality, which sounds right. But it's also the case that low interest rates fuel high asset prices, which also exacerbates income inequality. So it seems like there's some tension between these arguments.
Yes, yes, exactly. So you can have opposing forces in all of this, and kind of the main message of this research is that if you look at the net effects, you can see that when you raise interest rates, it increases inequality, and if you lower interest rates, you decrease inequality. And maybe what's happening is that when you lower interest rates, you actually help a lot low-income people, because now they can get jobs and they can have much higher levels of income and consumption, and that's why inequality is shrinking.
That offsets the estimate.
Well, according to this estimate, yes.
Sir, Ron, down here.
I'm wondering what the protesters waving the signs you were showing at the beginning, what they have in mind and how that corresponds to the analysis being done here, and whether there's been a sort of progressive left-wing analysis of this in the past that things that had somehow escaped the attention of monetary economists.
Yes, so it's, okay, I didn't participate in the movement. I don't know what they really wanted. But my reading of what they wanted is, in a way, is misguided. They saw that the central bank is an evil institution which is caring only about the very rich people. I don't think it's true. But in terms of policy implications, what this means is that when people change interest rates, they should think about what kind of groups of population are going to be affected. That's A, obviously. And B, they have to really improve their communication, because until the 99% movement, the Fed was perceived as a secret organization run by some conspiracy group of people, and that was obviously very wrong. As a matter of fact, I know the Fed is actively trying to improve its image and say, look, we're not this evil people. We actually do something good for the economy, even though some people disagree at the very top.
One more question right there.
So have you had a chance to study your charts with the negative interest rate environments in Europe and Japan? Because the zero floor is something that is somewhat specific to the US. I think that might be for political reasons or others. But did you have a chance to study those environments?
Yes, no, unfortunately in the US there was no variation which was negative, so I can't really say anything. But we should keep in mind that you can go negative only so much, right? If you go really, really negative, -3%, then we can have a great deal of disintermediation, and it's not necessarily a redistributive policy. It can be just in general very bad for the economy. So in quantitative terms, I don't think it will be terribly different. But it's something for future research to find, because lots of poor people rely on bank deposits, and they will be badly affected by this.
Well, thank you very much for your presentation.
Thank you.
Okay. Thanks for having me. It's an interesting conversation to be having. So I want to talk to you, change gears a little bit from monetary policy to the social safety net for the low-income population, and talk about some recent work that I and others have been doing that seeks to sort of answer the question, what are the long-run benefits of the social safety net that sort of exists in the United States and has existed for some time, that is really something that hasn't gotten much attention either from the research front or the policy frontier until some sort of recent work has been going on. So it was a motivating point, and to build a little bit on the excellent starting point that Peter started us with today, the sort of backdrop, I think, for thinking about the social safety net today for families and children, not the social safety net for sort of the elderly and disabled, which is a different piece of the social safety net that I'm not going to be talking about, is really the observation of stagnation of wages for low and middle skill families and workers in the United States. And increasingly, our social safety net is one that's organized around topping up wages and earnings as opposed to sort of supporting non-work. It's a big transition that our social safety net has engaged in over the last many decades. And I'm going to show you some figures that demonstrate the central importance of programs like the Earned Income Tax Credit and Child Tax Credit, food stamps, and other programs for reducing child poverty and, in a kind of contemporaneous period, reducing inequality. And that we've known for some time. But what we've only recently gotten a little bit of purchase on is the fact that those calculations may be really underestimating the power of the social safety net for reducing inequality. And the important sort of research that I'm going to talk about today illustrates the fact that what's been missing in our calculation about the importance of the social safety net, both in the research and in the policy, is that providing more social safety net assistance, particularly within the lens of thinking about children, turns out to have an important benefit in terms of the children's long-run trajectory that acts to reduce inequality. And so I want to give you a little bit of insight into that work by focusing on some of the work that I've been doing on the food stamp program and the engine that the food stamp program has for potentially having important impacts for reducing inequalities in the longer run. And so just as a kind of to fix ideas, there's many kinds of policies that we think about within an investment frame. And I think that preschool education is a very common one to be talked about in this frame. You know, in order to expand preschool, which many states are doing or debating doing, you've got to pay resources up front to expand that preschool education, teachers, classrooms, et cetera. But in the long run, the idea is that those investments are going to pay off because those children who get access to that increased preschool are going to experience better education in the longer run, higher rates of transition to college, higher earnings, and so on. And critically, those benefits are partially private, like it's good for my child to have better earnings and, as we connected to earlier, better health and all the rest. But critically, additionally, there's also substantial public benefits. In other words, reductions in government transfers and increases in taxes that result from that investment. And so we're very commonly talking about policies like preschool education within the context of this sort of investment frame, but we really do not talk about the social safety net within that frame. And what I want to tell you about is the fact that there's this sort of emerging literature that suggests that we should be, and that a significant component of benefits of the social safety net could be operating through these as yet sort of not fully quantified long-run benefits that fit within this investment frame. So I'm going to tell you about some work that I've been doing with various co-authors that focuses on one element of the social safety net, the food stamp program. And at the end, I'll sort of tell you a little bit about, very quickly, the fact that these findings are really showing up quite broadly across other important policies and programs that are geared at families with children in the United States. So just as a starting point to build a little bit on the conversation at the beginning this morning, this shows you the trends in wages or earnings by education level all the way back to 1980. And these are cumulative real earnings gains at the median within each one of these education groups. And the critical sort of takeaway from this series is that workers at the low and median levels in terms of the skill distribution are experiencing the lack of increases in wages. So we've got stagnating earnings and declining earnings over many decades in the United States. Of course, there's cycles, there's periods of some gains and periods of declines, but the overall trend is one of not being able to keep up with changes in prices. As I think Gabriel will be talking about, zooming out a little bit from that narrow perspective on earnings is the fact that when we measure resources more broadly, including other measures of income as well as other kinds of spending in the government, we see a sort of similar and striking pattern of declines in resources for the bottom half of the distribution that is almost offset by the gains in resources for the top 1%. As an optimistic note of what the social safety net can do in the short term, you can see here the green line tracks the comprehensive measure of poverty in the United States for children using the supplemental poverty measure, which incorporates the tax and transfer system and its anti-poverty fighting aspects. And that's the green line. And in contrast, the black line traces out in a mechanical way what poverty would be for this group if we simply took away the social safety net in a sort of static way. We just zeroed it out and assumed nothing else changed. And what you can see from that is that the black line, which what we refer to as market income poverty, is of course extremely cyclical. In good economic times, poverty falls, and in bad economic times, poverty increases. But aside from that cyclical aspect, you see very little progress in reducing child poverty in the United States. Yet you get a somewhat different picture from looking at the green line, which is showing you that we still have tremendous rates of poverty at about 15% at the end of this period, and a lot of the improvement is really coming through the expansion of the social safety net. So that just sort of sets up thinking about the importance of the social safety net, and unpacking that a little bit. This graph gives you a sense of what our spending on different parts of the child-focused social safety net is in the United States. And you can see that, again, getting back to our conversation about the importance of health expenditures in the United States, Medicaid is the largest category of spending on children in the United States, followed by the tax credits, the earned income tax credit and the child tax credit. And then after that, more transfer-oriented programs, food stamps, or called SNAP, and other programs you can see down the list. So that's where we're spending the money in the social safety net right now for children. In terms of thinking about that through the lens of where is the poverty reduction occurring, it's the tax credits that are really doing the bulk of the anti-poverty impacts of the current social safety net, particularly the earned income tax credit and the refundable component of the child tax credit. But you also see important anti-poverty fighting aspects of the transfer part of the social safety net, and as a little bit of a footnote here, the effects on the SNAP program may be as much as double the official statistics that I'm reporting here due to increasing underreporting of SNAP in our standard government surveys. So before talking a little bit more about this research on the food stamp program, two kind of important touch points to think about the context of our spending in the United States. The first is that our spending on children is far below the tax and transfer system, is far below our spending on the elderly in the United States, and the rate of change for the spending on the elderly far exceeds that for the spending on children. So the question that may emerge out of this research that I'm going to describe may be, are we underinvesting in children in terms of where we're spending the resources in the budget? Secondly, compared to other countries, and this is just an OECD comparison, we spend a lot less on families and children than do our counterparts in the rest of the OECD. So to switch gears and to focus on the food stamp program, so you already saw that it's one of the largest components of the social safety net for children or families with children in the United States. We have about 42 million people participating in the program, receiving about $250 per household per month. Eligibility requires having low income, and the benefits of the food stamp program are essentially vouchers that allow you to purchase anything in the grocery store that's food. So it's a quite unrestricted sort of benefit that operates very much like cash in practice, is what we find. So it turns out that the work that I've been doing essentially in terms of being interested in quantifying the long run effects of a program like SNAP, of course requires you to look back in time in order to do this evaluation. I can't tell you about the long-term effects of the food stamp program for people participating today because I don't have data to look into the future. So by looking into the past, we can quantify what effect the food stamp program has on the life trajectory of children. And so it turns out that what's valuable for doing that from a standpoint of statistical research design is that in the origin of the food stamp program in the Great Society period in the 60s and 70s, food stamps was rolled out across the 3,000 counties in the United States over a 15-year period in a rather bureaucratically eclectic way. And that's great. We like that when we're doing sort of statistical analysis, to have this kind of random rollout of programs. And that was an important feature of the beginnings of the food stamp program that, as you can see, started under President Kennedy as his first executive order in 1961 and followed through congressional legislation in 1964 and 1975. And the result of that is essentially an almost like very like linear rollout of the population's exposure to food stamps. If you were born as a poor child in 1964, there would not be many counties in America that would have food stamps. But if you were born as a poor child in 1974, it was available virtually nationwide. And you can see the geographic sort of variation in the rollout of the program, of which part of it, and there's not the sort of typical regional pattern to that we're used to seeing in the context of studying the generosity of the social safety net. New England, for example, was very late to adopt the food stamp program, which wouldn't fit with your kind of expectations. So what we do is take data from the modern period, know from our data where people were born and when they were born, and with that, relate the timing of when food stamps was implemented in their county to their characteristics today, and characteristics around health, human capital, and economic self-sufficiency. And essentially using that sort of rollout across counties and where people were born and when they were born in a sort of standard difference and difference approach in order to evaluate what the program does for the child's life trajectory. So very quickly, why might we expect to see more food stamps in childhood, leading to differences in educational attainment, earnings, and health in adulthood? This sort of health pathway relates in some ways to this well-established Barker hypothesis that relates the importance of nutrition in early life to both kind of metabolic health in adulthood as well as economic outcomes. In addition, there's, of course, a tremendously large literature that quantifies the importance of investments more generally in early life and impacts on economic outcomes that could feed into this kind of lens and theory and framing of these kinds of findings. So in the first study that I did on this with my co-authors Diane Schanzenbach and Doug Almond, we focused on this health pathway because of the importance of this Barker hypothesis as already having been so well established in epidemiology and many economic outcomes. And so what we do is we measure people's metabolic health in adulthood, which, as you can see, is sort of related to obesity, high blood pressure, diabetes, heart disease, incidence of a heart attack. We construct an index, a measure that encapsulates all of those 5 different aspects of metabolic health, and we relate people's metabolic health in adulthood to how old they were when the food stamp program was rolled out in their county. And so this is the main finding from that paper. And so this is what we refer to as an event study diagram. And on the x-axis, it marks how old you were when food stamps was implemented in your county. And in this diagram, the left out year is age 10. So that one is marked at 0 on the diagram. And as you move to the left on the x-axis, the data is capturing how different is metabolic syndrome risk in adulthood if a child was first exposed to food stamps when they were younger, age 8, age 5, age 2, age 1, et cetera. And what the takeaway from this, what these findings are, is that more exposure to food stamps in early life leads to a reduction in metabolic syndrome in adulthood that seems to be focused on the years between in utero exposure and around preschool age. So between ages 10 and ages 4 to 5 on that graph, it's a flat line, which means providing more exposure to food stamps doesn't change the metabolic syndrome risk. Yet somewhere around that preschool age, you see this dramatically linear, what we would often refer to as a dose response. So a little bit more exposure leading to a reduction in metabolic syndrome. That's bad, so reducing metabolic syndrome is good. And then once you get to be in the period of before you were born, it shouldn't matter if food stamps was in place 5 years before you were born or 3 years before you were born. You were exposed to food stamps in your whole life. So on the far left side of the graph, the flat line is sort of what we call a placebo test, or a sort of test of the identification strategy in the statistical model. So these are all in standard deviation units. And so what this is saying, and I should say that this model is applied to a group that was born into families of disadvantage. And so what we find is that more food stamps, lower risk of metabolic syndrome in adulthood. And these people aren't that old yet. They're maybe at the oldest point in their 50s, given doing the math in your head about when this program was implemented. And these kinds of benefits are both private, to get back to before, and also have incredible public aspects to them, given the importance of the government sector in terms of health costs. So that's the first result. More food stamps, better health in adulthood. What we've been working on now is really expanding this to look at economic outcomes. And we have this new data that basically takes a 1 in 5 sample of the census in the year 2000, plus the American Community Surveys after that. So a very large sample of Americans. And we have that data now matched to Social Security records that tell us place of birth and date of birth, which is not in the census. At best, you know state of birth. And we use that in order to mine the rich economic variables that we have in the census, looking at the same kind of frame, relating the age of exposure to food stamps, when it was implemented in your county of birth, to your life trajectory in terms of human capital, economic self-sufficiency, and so on. The downside of the census is we only know about you at a point in time. We don't know about your family of origin. So we can't focus in on people that were born to families of low socioeconomic status, and therefore the numbers I'm about ready to show you are measured on the whole population, and you want to multiply them by about 10 to compare them to the results I showed you before. So they're still in standard deviation units, but there's a much lower overall exposure to food stamps in the whole population than a population born to low socioeconomic status children, families. So we look at outcomes in the kind of realms of human capital, labor market and economic self-sufficiency, qualities of neighborhood and residence, as well as mortality and incarceration. Those are the sort of domains that we're able to look at with the census. So this is the finding for human capital. And you can see below that our human capital index includes aspects of completed schooling, whether you have a professional degree, what kind of occupation you have, and so on. And the form of the event study is the same as what I showed before, although we have a lot more data, so I'm able to identify more of the data points. But again, everything is relative to 0 at exposure at age 10, which is an arbitrary normalization. So the human capital is, of course, a good thing, so more human capital is good. And what this diagram shows is that more access to food stamps, and again, particularly more access in that early childhood period, leads to an increase in human capital. So more food stamps before age 5 leads to higher rates of graduation from high school, even more rates of attendance of college. And not much evidence that it matters about access in later childhood. And again, the fact that the diagrams, the event study flattens out on the far left point gives you more confidence that this isn't just capturing some overall trend. So more food stamps means better human capital. More food stamps means better residents and neighborhoods. So we basically look at where people are living. We take their census tract and assign a bunch of characteristics to that census tract from the census, like poverty levels, female headship, other kinds of things, as well as your own home ownership. And we find, again, dramatic relationship between more access to food stamps and the quality of the neighborhood in which you're living. We also observe from the Social Security data precise dates of death if you're deceased. And of course, death rates are very low for people through their speaking as a 57-year-old. Not very high for this population, yet nonetheless, what we see is that I've converted this to not death but survival, so it's a positive thing. So an increase in survival to the end of the period is a positive. So more access to food stamps, again, in early childhood leads to reductions in mortality. So, and we find much smaller effects on economic self-sufficiency. So conditional on education, less results for earnings, income overall. So when you, very quickly, when you break this down by, we look at all of our results separately by gender and by race. And general findings are that when looking at aspects of human capital, they tend to be more concentrated among whites, and particularly white men. The results for mortality tend to be concentrated more among non-whites. The results for the neighborhood quality are very consistent across the four groups. That I did not show here. And then finally, we can use the information in the census. One of the things that is actually surveyed in the census is locations in group quarters, and prisons are a type of group quarter. And so criminal justice research uses this as a proxy for incarceration. And what we find concentrated for non-white men is that more exposure to food stamps leads to a reduction in being incarcerated at this point in time when we observe people. And it is, of all of the outcomes we've looked at, it is the only one that has basically a linear response all the way through childhood. So it doesn't matter if you get more access to food stamps at later ages of childhood or earlier ages of childhood. The marginal access to more years of food stamps leads to a sort of general improvement in the risk of being incarcerated among non-white men. So this work is very much at its infancy, so I don't have many answers about what's driving these impacts. These are the first kinds of estimates we have of the long-run effects of a program that's been around for 50 years, which is pretty remarkable. But before concluding, I do want to point out that there's a lot of research like this going on, looking at other aspects of the social safety net. There's been a ton of research on the Medicaid program. Importantly, as you saw, it's a very large component of spending even for families with children. And there's been an enormous amount of expansions of Medicaid even before the ACA and dating all the way back to the late 1980s. That allows us to do the kind of long-run analysis, and that work being done by groups of scholars around the country is finding very important impacts of increases in health insurance in childhood on not only the health domain, but also on human capital and economic self-sufficiency that are really important and could really change our notion of what the benefits of these programs are, as well as other research on other elements of the social safety net, like the earned income tax credit and cash welfare. So just to conclude, the punchline is, for a long time as economists, we very much, speaking for myself, and I think many others doing the kind of work that I do, we've been very focused on this sort of trade-off between the desire to reduce poverty and concerns about the distortive effect on parents and their employment. And the more protection you provide, the more distortion you generate. It's a standard sort of trade-off in public economics. And I think what that dyad has missed is the fact that these programs are targeted on children, and there's an aspect of the long-run benefits that don't fit within that sort of current period trade-off. And so the question that I have about the political conversation is, if we turn our movement away from the parents and the concerns about them to the potential benefits to the children, might that allow the blue points and the red points on Peter's graph earlier to maybe move closer together on these issues? So thank you very much.
So we have time for a couple questions. Peter? Yeah.
I'm sure you've got really interesting. I'm sure you've gotten this question 30 times. Since this is all driven off of the counties adopting food stamps, and since that was voluntary,
Right.
is there anything else that they were doing that, you know, they might have done food stamps and, I don't know, more early educate, whatever,
Right.
that might confound this a little bit?
It's absolutely true, and I went over it very quickly, that this was this rollout over this 15-year period was triggered by the beginning, where counties were voluntarily signing up for food stamps. So basically, USDA said, "Hey, we've got this new program. We're going to pay for it, but you need to ask for it." Was basically, and the critical element is they had to stop providing a pre-existing program called the Commodity Distribution Program, which was much more agriculture, farm-based support. So the big story here that describes the sort of rollout is a bit less about what else they were doing with the social safety net or even the local economic conditions, and a bit more about the differences between a more agricultural-based kind of setting and a more kind of urban, poor-oriented setting. And so what really matters is that you control for the fixed differences across place. But once you do that, it's remarkably impervious to at least the things that I've been able to add in. Because so many others are doing work on the Great Society period, I feel pretty confident that it's not that all these other Lyndon Johnson programs were kind of happening at the same time. I think it's more about this kind of political economy of this story, at least for this program.
Brett?
Hillary? 10 years ago, I'd have found that answer completely convincing. But I've looked at the past 8 years at the Medicaid expansion take-up, where there is a very large plus for a region or a state, and no downside whatsoever. And so I find myself wondering whether the kind of sociological belief that poor people deserve to be poor and their children deserve to have lousy lives might be acting back then in the same way that's been acting over the past 8 years. Can you reassure me that that's not the case and that's not an important co-founder here?
No. I mean, it is. I mean, it's like the hardest thing about this work and standing up here and talking about it, me personally, is that I'm talking about a period in the 60s and 70s. And, you know, I don't know what to do. If I want to talk about the long-run effects, that's the only option I have. But we live in a very different situation today. So I can't, I'm no expert on the political setting, but I see this coming in a little bit. And people talking about, like, investments, you know, government policy as investments. It certainly doesn't seem to be showing up in what the last 8 years of the Medicaid expansions, but people are voting on it in the last election. So I don't know. I'm an optimistic person. I'm from Wisconsin. We're optimists in Wisconsin. So I don't know. That's a great question, but I can't say.
Let me ask you a quick question, and we'll have to end with this. So the programs that you're talking about are not specifically aimed at preschool kids. You're just looking at showing that the effects are big for preschool kids.
Right.
Have you looked at or do you know about if one were to look at the social safety net and infer how much of it is directed at that population relative to just all kids or adults? And obviously, in some cases, you'd have to infer that, for example, by the marginal effect of how much bigger the EITC is if you have another little kid and so forth.
Right.
Do you have a sense of what fraction of the safety net is directed at that population and how that's changed over time?
It's definitely not, most of it is not directed. That is, most of these programs, the eligibility is you have a kid.
Right.
It is true that when Medicaid expanded, it expanded more up the income distribution at the younger ages first, so that's true. Probably the most important aspect is the more life cycle one. That is, single women with children are less likely to be working when they've got a kid of age 1 and more likely to be working at a kid at age 8. So I think you bring up actually a really important point that I don't really adjust for here, and that is that, if kids aren't participating as much in food stamps when they're age 15 because their family's less likely to be eligible because of the normal kind of life trajectory of particularly women and the labor market and children and their age, then part of this might be corresponding to that a little bit. I think that it's probably not all of that because of the kind of sharpness of the diagram, but it could be part of it. I don't know of a good accounting of the costs like I gave you earlier, broken down for, say, preschool age kids. I think it would be doable, but I've not seen that, and I think it would be a useful lens to apply to this.
Well, thank you very much.
Thank you.
Well, thank you. And very much enjoying all these talks and learning a lot. And Peter has already told you a fair amount of what I'm going to say, but probably you've forgotten by now. Health and length of life and physical vigor, absence of disability, and so on, these are all at the core of our human well-being. And I'm going to be talking, well, fortunately, as we've heard, life expectancy has been rising, health has been improving on the whole in the United States over the past century, and pretty much around the world with some exceptions, and all that's great. But it does turn out that underneath these generally very favorable trends, there's some unfortunate things going on as well. One of these is the recent slowdown and reversal in life expectancy change that was mentioned earlier. The other that is more important for our present purposes is the large differences in life expectancy and health by socioeconomic status, and particularly puzzling, I think for me anyway, is how rapidly these have been growing in recent decades. So I'm going to be talking about these. First, I'm going to, after a little introductory stuff, I'm going to document the differentials in mortality and life expectancy in the US. Then I'm going to talk about how these affect progressivity of government programs, and then I'm going to talk about how some of the policy changes that are being considered as a response to population aging and its impact on sustainability of these programs, how those policy changes would interact with these differences in mortality by socioeconomic status. Before I move on, I also want to say that although I and the report that I'll be drawing on focused on US federal programs with pay-as-you-go Social Security being a key central one, these concerns are not limited to pay-as-you-go programs. They're not limited to the public sector. They're not limited to the US. They're the same or very similar problems that come up with a defined contribution system if you're investing in your retirement account, because you may want to convert that into an annuity when you retire, and if you convert it into annuity, you're going to get a better deal if you're high income than if you're low income, for example. Or if you're in a country like Sweden or Italy with a notional defined contribution system for pensions, you're going to have the same problem, again, because of the annuitization at the time of retirement. Okay, well, let's move on here. I'm going to be drawing on the report that was Alan mentioned and Peter mentioned This is a report of the National Academy of Sciences. Peter and I co-chaired the committee. Alan Auerbach here was on the committee, as well as a number of other people. If you're interested, it's a free download from National Academy's Press at that URL. Okay, so life expectancy has been rising. Here we're just looking at it from 2005 up to what was the most recent data until yesterday. So we see it was rising relatively rapidly, and that was pretty much on historical trend. Then after 2010, rate of increase slowed down. After 2014, began to decline. Dropped, I think, 0.3 years to 2015. Then it dropped another 1/10 of a year. And now we learned yesterday it's dropped another 1/10 of a year. That is, well, if we look at life expectancy at age 65 for older people, that actually increased slightly this last year. The hit is for people in the early working years who have had an increase in age-specific mortality, probably closely tied to the opioid epidemic and so on. But what is going on here? I would say we don't really know, but it's not, there's something a little bit like this in the international data, but it's not really anything like as strong as this, and it reversed. It was more tied to influenza deaths and so on. I personally expect we'll be resuming a strong upward trend soon, but we will see. Now, the growing gap is what we're focusing on here. And we know the proximate causes because it comes from more rapid reduction in mortality from heart disease and cancers at the top of the income distribution than farther down. And that may be related to what we heard about earlier, the reduction in smoking or less uptake of smoking in the higher income groups, and that affects mortality for many causes. And then we also have the rise of the opioid epidemic, primarily affecting people in working ages and hitting hardest for whites. Okay, so let's now look at mortality levels and trends by socioeconomic status. I was a big skeptic on this, I must say, when we started looking into it in the committee. But this is a very persuasive chart. This was produced by Hillary Waldron at the Social Security Administration. And what we see here is we're looking at life expectancy at age 65 for birth cohorts, people born in 1912 up to people born in 1941. This is remaining years of life at age 65. And the black squares are for the lower half of the Social Security earnings distribution, and the white squares are for the upper half of the earnings distribution. And you can see that over 30 years, for the generations born over a 30-year span, there's hardly been any increase for those in the bottom half of the earnings distribution, and there's been a substantial and steady increase for those in the top half. So that was an inspiring paper, and a number of people have built on that. And in particular, Bosworth and various co-authors has done very interesting work building on it. And the strategy there was, rather than just sticking with Social Security data on earnings and mortality, to use the Health and Retirement Survey, which is a very rich longitudinal survey with lots of socioeconomic data, which is linked to Social Security earnings records. And then they also looked at SIP, which is a larger national survey. And they find very similar results. And in particular, here I mention for life expectancy at age 50 is when the Health and Retirement Survey picks up the life cycle. At age 50, the top decile of men lives 9 years longer than the bottom decile. And for women, that difference is 12 years. So these are, at least to me, these are huge differences that I could scarcely have imagined before we started working on this, particularly since I knew that black-white life expectancy was converging. How could it be that these socioeconomic differences were diverging in this way? Now, most of the research has looked at education rather than income for various reasons. It doesn't change over your life, it's widely available, and so on. So these black lines, here we have males, on the right we have females. We're going from 1990 up to 2016. The black line is the average. This is life expectancy at 25, an age at which people are mostly done with education. And the lower education groups, including less than 8th grade and less than high school, are down here, and the higher education groups here with college or postgraduate work up here. And you can see that in 1990, these are closer together and the gap is widening a lot. And for women, they're even closer in 1990 and then also widening. Now, that it's well known, sort of exaggerates a bit because the pool of people who have less than 8th grade education or less than high school education is getting smaller and smaller as a proportion of the population and more selected on other characteristics that would have an adverse effect on health and mortality. But you find something rather similar to this after you control for that by, say, using a quantile measure of education, something of that sort. Okay. Well, our committee follows the Waldron and Bosworth approach. We worked with the Health and Retirement Survey. What we want is mortality by age and by sex, and beyond that, we don't care. We don't want to know about any other characteristics. We don't want to know whether poor health is causing higher mortality and lower income. We want that part of the association. We don't care if low income is causing poor health. We want that part of the association, and we don't care if other attributes like geographic location are causing both low life expectancy and low income. We want that in there too. We just want the association between the two, and that's what we estimate. So we use Health and Retirement Survey. We're following others in using an average of Social Security earnings at midlife. There's reason for that, which I won't go into. We do an adjustment for couples that have two earners. And then we're arranging individuals into earning quintiles separately for males and females. So we have the bottom 20%, the others, the top 20%, and so on, both for males and females. And as in what we've looked at with Bosworth before, we're looking at life expectancy at 50. Now, I should say, so we estimate a model and so on. We are going to be focusing on birth cohorts of 1930 and 1960 in using the results of this analysis. The 1930 cohort, we observe a nice span of ages and we can estimate things pretty well. But for the 1960 cohort, we don't observe anything after age 50, and we're basically simulating, imputing, projecting from the model for that year. We are observing cohorts pretty much up until 1960, but still, it's important to keep in mind that these are, let's say, projected data. You might think of it as a high mortality dispersion scenario. Okay. Well, here's what we found. You can hear me okay when I'm standing here, I hope? Yeah, okay. So there are going to be a bunch of graphs that look more like this, more or less like this. So we have males here, females here, earnings quintile, the lowest income, second, third, fourth, and highest income here. The blue bars are for the 1930 birth cohort. The orange bars are for the 1960 birth cohort, and we're looking at life expectancy, remaining life expectancy at age 50. So for males, for example, we see that for the low income group, life expectancy didn't go up at all over that 30-year period. We can also see that for higher income groups, it went up quite a bit. And here, as elsewhere, I'll often be contrasting the difference between the top quintile and the bottom quintile and how that changes between the 1930 mortality regime and the 1960 mortality regime. So for males, that interquintile difference rises from 5 to almost 13 years. And for females, it rises from 4 to almost, to 13 and a half years. So we see a very substantial widening here of the mortality differential. There have been, this research has continued. Bosworth had more papers. Case and Deaton have a couple of papers that have gotten a great deal of attention about deaths of despair and so on. Chetty has had some very interesting papers, and I'd say none of these are inconsistent with any of that, and Chetty finds quite similar numbers if you look at average or median outcomes. Room has, and collaborators have done a couple of papers, one finding that short-term macro shocks do lead to increased deaths from drugs, but that medium-term swings do not. So he suggests that really these aren't deaths of despair. But what I want to particularly mention is work by Curry and Schwant, a couple of papers, because they looked at mortality at younger ages, and they looked at this by county, and they found that socioeconomic differentials in child mortality had been getting narrower. And they interpret this, if I remember correctly, as being entirely consistent with what Hillary just told us, that I don't think they have any direct evidence in those papers, but what they think is that it's the effect of these government safety net spending programs on children that are leading to better health outcomes. And again, going back to what Hillary was saying about these very delayed effects she's finding, if that's so, then it bodes well for trends in the future. Perhaps there will be some contraction of these differences as these earlier generations get older. Hope so. Okay, so now we are particularly interested in the effect on government programs, and that's what we'll look at here. So we used what is called the Future Elderly Model, which is based at USC and was developed by Dana Goldman, who was also on the committee, and we got a lot of help from him and from the FEM staff. It's a big microsimulation program. that builds on the Health and Retirement Survey, and taking a baseline population from the Health and Retirement Survey, it simulates it, micro-simulates it forward. And we used that in conjunction with our different mortality assumptions for the 1930 birth cohort versus the 1960 birth cohort. And then we calculate the present value of benefits and taxes paid or received after age 50. So in our simulations, we're using these different mortality regimes, this one with more dispersion than the 1931, and we're also letting health and disability vary in a natural way with those differences in life expectancy, but we're holding everything else constant. So the earnings histories are the same. The policy rules are the same for taxes and benefits. The quintile positions of all the individuals are the same. The only thing really that's important for the outcome contrasts we're going to be looking at are the differences in mortality dispersion and, to some degree, health and disability. Now, Social Security is supposed to be progressive. This is, in terms of benefits, this is the plot from Social Security trustees showing the bend points on the replacement rates. And you can see if you're poor, you get 90% replacement of your pre-retirement earnings. If you're at the top, at the margin, you get 15%. So it's designed to be progressive in this way. The question is, if rich people live longer and so on, how does that interact with this progressive benefit system? So this is what we found. So here we have the 1930 cohort. Here we have the 1960 cohort. We're looking at males. Quintiles, again, go from left to right. So this is the present value of Social Security benefits, lifetime benefits received above age 50. And not surprisingly, they're higher for the higher quintile because those people have paid much more in and so on. What we want to do is contrast the progressivity or regressivity, or however we want to, let's say, contrast the distributional aspect under 1930 mortality conditions to that under 1960 mortality conditions. And we see that there's a swing of $70,000 in net present value. That is, this contrast is smaller than that contrast by $70,000. And for women, it's by $48,000. So just the change in mortality gap has greatly altered the progressivity of Social Security. Medicare pays a lot more for poor people than for rich people, and poor people, because poor people are in worse health and use it more, and poor people are also paying less in taxes and so on, so it's very progressive. But how did that progressivity change? Well, same design here. Under the 1930 mortality regime, poor people received a present value of benefits slightly greater than rich people, but under the 1960 mortality regime, that had changed. And here there's a swing of $53,000 in present value for men, and women who live longer and are generally in worse health than men, that high-low difference rises by 70,000. So these are big, big swings. Medicaid is even more progressive than Medicare because it explicitly has a means test and so on. And so you can see the present values are much higher for the low income. But even here, and you see that for women are receiving about twice the benefits as men because they're living longer and they're also more likely to need long-term care. But again, even here, there is a swing of $7,000 for males and $36,000 for females. Okay, I'm not going to show you, we've done something similar for disability insurance and for SSI. I'm not going to show those in the interests of time, but if we put them all together, we get this picture on the sum, in which there's a swing of 126,000 in present value for men and 155,000 in present value for women, in the direction of going towards less progressivity or more regressivity. So that's big. Now, I have not much time left, but population aging is happening very rapidly right now. It's happening partly because of rising life expectancy, but even more because of low fertility. But in any event, here it comes. We're going to be, we hope, at some time, making policy adjustments to improve the sustainability of our programs. And those adjustments are going to interact with mortality differences by socioeconomic status. Raising the early retirement age from 62 to 64, that has very little effect, redistributive effect. Raising the normal retirement age has some redistributive effect. If we look at it in terms of dollars, it leads to a reduction of 30,000 for the lower quintile and a reduction of 59,000 for the upper quintile. In that sense, it would increase progressivity. If we look at it as a percent change, though, the lowest quintile is taking a 25% hit, and the top quintile a 20% hit, for the obvious reason that poorer people are not going to be living as long after retirement, and so when you raise the retirement age, you're taking away a higher proportion of what they have. Changing the marginal replacement rate at the top has very little effect. Making a really serious change here in putting the marginal effect on benefits at zero above $3,000, which is what we simulated in this case, that reduces the high-low interquintile difference by about $42,000, or about 25%. So that has a significant impact. Raising the eligibility age for Medicare has a smaller effect than we might expect, because healthcare costs in these ages are relatively low compared to older ages, and because for poor people, they have alternative routes to qualifying for Medicare through disability. So this is a slightly regressive policy, but not highly regressive. And then I'm going to shift gears and say none of those policies was designed to really counteract this, the effect of life expectancy differences on progressivity. If we set out to design a policy to do that, one idea is just to have a different retirement age for different long-term earnings groups. You could do this somewhat the way we do now with the replacement rate and benefits that we just saw. The principle of having different conditions for people in different long-term earnings groups is already established and accepted. We have the information base needed to implement it. So we could make, say, have 5 different life tables, or 10 different life tables, or 3 different life tables. And we could also have the normal retirement age adjust automatically as life expectancy changes in the future by group. Perhaps there'll be a convergence, perhaps there'll be a divergence, perhaps mortality change will slow down, or perhaps it will speed up. And there could be an automatic response that would be sensitive to health and mortality differences across the socioeconomic groups. Well, I think I will leave it at that. Thank you.
So I think we have time for maybe one question or two. Well, let me lead off again. We have one over, and then this person over here. Ron, so the last thing you talked about, which would be income-based adjustment, or lifetime income-based adjustment, basically would be shifting the program more toward a means-tested program, effectively. Not fully means-tested, but more, lower benefits going to higher income people per year to offset the life expectancy. One of the resistance to such approaches have been proposed for other reasons. For example, saying that we can't afford these programs, we've got to cut back. Where are we going to cut back? We'll cut back where the need is not as great. But it would effectively, at least by group, end up having the similar distributional effects as what you were suggesting, based on life tables. Resistance to such approaches often comes from groups in the political process that want to preserve you might say, the fiction that these are contributory, uniform programs, universal programs, as opposed to transfer programs. Do you have any thoughts on the politics of that?
Absolutely, because the hard sell for that is the benefit schedule we saw. But this one is easy. This is just a straightforward actuarial adjustment to achieve fairness in the payback. The same arguments, as I say, apply for a DC system, for annuitization rates, for the notional defined contribution systems that are supposed to mimic actuarial fairness and so on. So I think people haven't realized this feature, and that just pointing it out and presenting a policy suggestion like this in terms of an actuarially necessary adjustment or something like that might make it acceptable. That's my hope. And I'm actually doing, have a couple of papers with a couple of other people trying to model and look at sort of responses in a system with more feedbacks and a more general equilibrium type approach. And I think it's worth exploring.
There was a question over here.
That's Josh Goldstein, who's an expert in these matters.
That is hard to ask a question after that. But no, my question is philosophical, I guess. If you started with the point that inequality in length of life is unfair anyway, and so even if we give everybody the same expected value of their pensions, you're not compensating them for their shorter life. It seems like the money is the small part of the story.
I agree absolutely, and left out a slide I meant to include earlier, in which I'd say, yeah, this is a big problem, and the first order problem is that these differences exist, and policy and research should be addressing them in a strong way, and this is just a kind of secondary consequence of these differences. It's not the main show, it shouldn't be the main show, but it's something we can do to nibble at the edges of the consequences of this unfair hand and that nature deals, and the kinds of programs that Hillary was discussing might be one good way to address these problems.
Well, thank you very much.
Thank you very much. Thanks for being here. Thanks to the organizers for such a great conference. I learned a lot, so thanks to all of you. I'd like to talk about distributional national accounts, and the starting point is that there is, I think, a lack of visuals. But I can keep talking. There is, I think, one problem, one big problem today with economic statistics, which is that there is a disconnect between our headline economic indicator, which is GDP growth, and how much, how most people feel about the economy. One striking example is you look at growth since the Great Recession. Okay, the economy has been growing quite a lot, but this is mostly because of a growth in corporate profits and a growth of wages in the upper part of the wage distribution. Most people feel that, and that's what's written here, most people feel that their own income has not grown so much. Okay, and the problem is that we don't have today a very good way to quantify that. Okay, we don't have a good way to tell how much income is growing for each social group when GDP is growing 3% a year. And what's the reason for that is because the way that we study growth and inequality, these are two kind of different worlds. On the one hand, people who study growth, they use national accounts data that have aggregate information about GDP, total national income, total consumption, but no information about how these aggregates are distributed. And on the other hand, you have, economists and people in the social sciences more broadly and statisticians who study inequality. But to study inequality, they use survey and tax data that have distributional information, but that information is typically inconsistent with the macroeconomic totals in the national accounts, in the sense that you take the total flow of income in the tax data or the total flow of income in survey data, and it adds up to much less than total GDP. The problem is that this gap makes it hard to know how growth is distributed, which is interesting in its own right, and maybe more importantly, it makes it hard to study what's driving the rise of inequality. Okay, and so with the data we have today, we can't really tell how much income is, to what extent income is growing for the bottom 50%, the middle 40%, let's say the middle class, and the top 10%, how much their income growth compares to total macroeconomic growth. We are not able to say what part of the rise in inequality owes to changes in labor, in the relative importance of labor income and capital income at the macroeconomic level versus changes in how labor income is concentrated and how capital income is concentrated. And the third problem is that we don't have a clear picture today of how government spending, so taxes and transfers, affect the distribution of economic growth. Okay, so is it the case that the government is equalizing growth, or is it the case that the government is making growth more unequal than it already is? So the goal of this project, Distributional National Accounts, is to try to make some progress towards bridging this gap, between growth on one hand and inequality on the other hand. And so today I'm going to mostly talk about the results we have with Thomas Piketty and Emmanuel Saez for the United States. And you should think of this as kind of prototype for a new set of economic statistics, which we call distributional national accounts. And this prototype works as follows. So what we did is that we constructed a micro database of income and wealth and government taxes and transfers that's consistent with the macroeconomic totals for the US. So think of this database as each line represents one synthetic individual, so not one real person, but the database globally is consistent for the US population as a whole. So each line is a synthetic individual, and each column, each variable corresponds to what is recorded in the national accounts today, to the variables that are in the national accounts, so GDP, national income, consumption, saving, and so on. And then when you take the sum in this database, over all lines, you get the macro total, you get the national accounts total GDP, total national income. The distributions in this database are consistent with the distributions that we see in tax data, in survey data. The joint distributions are consistent as much as possible with what we see in the microdata. And so with this database, we can do two things. We can compute growth rates for each quantile of the income distribution, let's say the median or the 90th percentile or the 10th percentile, that are consistent with macroeconomic growth. And second, we can assess the total redistributive effects of government intervention. That is, when you look at income before any form of government intervention versus income after all forms of government intervention, all transfers and all taxes, which distribution is more equal than the other, and to which extent the post-tax distribution, post-transfer distribution of income is more equal than the pre-tax, pre-transfer distribution. So in many ways, this is getting back to Simon Kuznets' original intent to study, growth and inequality jointly. Kuznets invented with others, Mead, Kendrick, Duget in France, invented the national accounts. He also pioneered the use of tax data to study inequality. So he was the first one to compute statistics on the top 1% income share in the United States. But he never, combined the two approaches and really produced consistent series of growth and inequality. So that's what we're trying to do. All right, so let me tell you very quickly how we do this in the US. I'm not going to bother you with too many methodological details, but very simply speaking, what we do is a pragmatic combination of basically all the data sources that exist. So starting with tax data, which are valuable in the sense that they are very good at capturing the top of the distribution, supplementing publicly available tax data with tax information that's available internally at the IRS, supplementing tax data with survey data, very important to cover the bottom of the distribution, very important to cover transfers, many of which are not taxable. And we make a lot of assumptions for many forms of income that are not directly observable in either tax data or survey data. It's a bit like GDP. It's very much like GDP. GDP is built by combining lots of data sources, making lots of assumptions in a conceptually consistent framework, one that's regularly improved, one that is internationally agreed. And what we're trying to do is exactly the same thing for distributions. And the advantage of this, so the point is that we are not going to have perfect answers to how all forms of income are distributed, but we are trying to start this process, and the hope is that ultimately this will be taken over by government agencies. The government agencies will publish distributional national accounts, not only in the US, but also in other countries, so as to make it possible to compare inequality across countries on a solid footing, just like we compare GDP across countries today using the national accounts. Okay, so we have, you can think of income in two ways. You can think of income as income before government intervention and government intervention and after government intervention. So more precisely, we define three concepts of income. One is what we call factor national income, so the sum of all labor income and capital income in the economy. And then our benchmark concept for the distribution of income before government intervention is what we call pre-tax national income. So compared to factor national income, this subtracts contributions for pensions and social insurance and adds the corresponding benefits. So you can think of pre-tax national income as kind of market income the wages and capital income that people earn, including the deferred wages that they earn while retired. Okay, and then the third income concept is post-tax national income, where starting from pre-tax income, we subtract all other taxes other than social security contributions, and we add all forms of government spending other than social security spending. Okay, and so these three income concepts, they all add up to national income, which is very close to GDP. And so by comparing pre-tax national income and post-tax national income, you can have a complete view of the redistributive effects of government intervention. All right? So let me just show you this graph, which is probably the most important graph that we have. And there's a lot of, there are many things that are happening on that graph. So that's a graph that's showing, first, the horizontal line is the average growth of per adult national income since 1980, the annual average growth. This graph is over 1980 to 2014, but it would be very similar if you looked at 1980 to 2018. So the growth of average per adult income in the US from the national accounts has not been so great, since 1980. So average income has grown 1.4% per year on average. That's what you have, that's what you see when you look at the national accounts, okay? The interesting and the striking finding is that for basically almost everybody, all income groups, their income growth has been very different than the average 1.4% income growth. So you look at all these quantiles here on the x-axis, and at the bottom of the distribution, income has been growing, 0%, 0.1%, 0.2%, very low growth rates of income in the lower half of the income distribution. And in fact, for basically 88% of the population, at least for all quantiles below the 88th quantile, income has grown less than the average income growth rate of 1.4%. Okay? If you want to see, the groups that have experienced something that's close to the macroeconomic growth rate, these are these groups here around the 85th percentile of the income distribution. And at the top, in the top 1%, income has been growing much more, than average national income. So a couple of, two extra points. One is that sometimes there's a view that what has happened in the US is that the top 20%, the top 2 deciles are doing well. The upper middle class is doing much better than the rest of the economy. And here, that's not really what we see. What we see is that, I hate to say that, but that's really what the data show. Where income is growing is not the 80th percentile, it's not the 90th percentile, it's not even the 95th, or not even the 97th percentile. It's the top 1%. It is really the top 1% that's been hoarding growth. And it's not even people in the bottom of the top 1%. Their income has been growing 2.5% a year. That's good. That's more than 1.4%. It's nothing extraordinary. Now, if you want to see really high growth rates, you have to move really high up in the distribution. You have to look at the 99.9th percentile, 99.99, and so on, and up to the very, very top 0.001%, where income has been growing 6% a year. Okay, so second point I wanted to make is that was all about pre-tax income. What happens when you add government intervention, transfers? So here, when you add government intervention, income has been growing a bit more at the bottom of the distribution, but we have to ask ourselves, where is that coming from? And so here I'm just focusing on the bottom 50% as a whole. You take the lower half of the income distribution, and I'm looking at the evolution of their pre-tax income and post-tax income. So number one finding, you look at the red curve, the average income of the bottom 50%, so average income for half of the population, today is around $16,000, $17,000, okay, on a pre-tax basis. Okay, so you have to realize this, that half of the population in the United States today, when you take into account all their pre-tax income, earns on average on a per adult basis $16,000, $17,000. Okay, so think about your income and compare this to, that's half of the US population. Number one. Number two is that for this half of the US population, their pre-tax income has completely stagnated since 1980. That is, for half of the population, in effect, has been shut off from economic growth, has experienced zero economic growth. That's still on a pre-tax basis. Okay? Then, when you add taxes and transfers, the top line, you have a bit of growth. But where is that coming from? A lot of it is coming from a rise in health-related transfers. Okay, here remember we allocate all forms of government intervention to each individual, so including in-kind transfers like spending on Medicare and Medicaid to their beneficiaries. Now, if you look at post-tax transfers, but excluding Medicare and Medicaid spending, then you get this curve here, and you see that post-tax income, excluding health-related spending, actually has barely increased for the bottom half of the distribution. And then you can ask yourself, okay, is it really the case that the bottom 50% benefits a lot from this Medicare and Medicaid spending, or is it really helping the poor, or is it more reflecting the very high cost of healthcare in the US and benefiting, mostly the pharmaceutical industry or healthcare providers in general. All right. I think Hillary showed these graphs. I'm not going to talk too much about that, but basically what happened because of the stagnation of the bottom 50% income and the rise of the top 1%, basically both groups have switched their income share. So in 1980, the top 1% income share was about 10%, the bottom 50 was about 20%, and now it's just the opposite. And it's pretty striking that these two groups, the two curves, they fit on the same graph, and there's just one axis, right? So obviously the bottom 50% is 50 times larger than the top 1%, but its income share today is about twice smaller than the income share of the top 1%. So if you do the math, it means that the ratio between the average income of the top 1 and the average income of the bottom 50 is about 100 today. Okay? Okay, let me discuss very briefly what new things we can do with distributional national accounts and what type of questions we can answer. One thing that we can do a bit better than previously is that we can do a better job at decomposing inequality into what comes from labor and what comes from capital. As you know, you can divide national income into the total flow of labor income and the total flow of capital income. Macroeconomists have noticed and are very much interested in this phenomenon that the capital share of national income seems to be slightly rising, has been increasing over the last decades. So that's the macro picture, but what we can do with distributional national accounts is we can compute factor shares, labor and capital shares, for each quantile of the distribution. And so what we can see is that for the bottom 90%, most income is from labor, so the capital share is very low. The higher up you move in the distribution, the higher the capital share. For the top groups, most of their income always comes from capital, with interesting variation. So in the 50s, 60s, up to 90% of the income of the top 0.1% was capital income, and only 10% was labor income. And then you have this gradual decline from the 1950s to the late 1990s in the capital share at the top, reflecting a change in the nature of top earners, the rise, if you want, of the working rate, the decline of the rentiers. But the trend has reverted basically since the late 1990s. What we find is that the capital share is rising again at the top, and consistent with this view that it's less and less a working rich story. The rise of inequality is less and less a working rich story. What we find is that most of the rise over the last 2 decades, most of the rise of the top 1% income share comes from an increase not in labor income, which increased a lot in the 1980s, 1990s, but almost all of it since the late 1990s comes from a rise in capital income. Okay, you also see this when you look at age, the average age of top earners. Of course, population, the overall population is getting older, but up to the late 1990s, top earners were getting younger. Okay, again, reflecting this rise of the working rate. Now they're getting older, and you have this sharp trend reversal around the late 1990s, beginning of the 21st century. So inequality, is changing. You can't analyze inequality in 1980s, 1990s as you can analyze inequality today. In the 1980s, 1990s, the rise of inequality is a labor income phenomenon, and so you have to think about the role of technical change, education, and so on. Since the late 1990s, since the early 21st century, most of the rise in income concentration has been a capital phenomenon. So here what matters is thinking about saving rates, differences in rates of returns, inheritance. It opens up a set of very different questions. Let me just, I'm just going to end with one graph, which I think is pretty striking. So what we're trying to do is to do similar distributional national accounts in as many countries as possible. And the goal by comparing countries is try to learn a bit more about what might be driving inequality. And so in the US, as I've shown previously, the bottom 50% average income has stagnated since 1980. And so if you want, we have 2 broad types of explanations as to why this has happened. You have one type of explanation that stresses the role of technology and trade and globalization more broadly. So basically, the working class has been doing poorly because of technical change, because of competition with China, and so on. And there's a second set of explanations which emphasizes the role of policies. Okay, changes in the minimum wage. The federal minimum wage has declined a lot since 1980. Changes in union power, changing in the bargaining power of labor and capital more broadly. And I think doing this comparison with France is quite striking. What you've seen is that in France, the bottom 50% average income used to be much lower than in the US in the 1960s, 70s, 80s. But then what has happened is that bottom 50% average income in France has continued to grow at roughly the same rate as the French economy as a whole, such that today, average income for the bottom half of the income distribution in France is actually higher, and that's adjusted for purchasing power differences, is actually higher than in the United States. And that's, that's interesting because France is also subject to the same forces of technical change, globalization, and so on. And so it suggests that if you want to understand the stagnation of bottom 50% income in the US, policies have really played a very important role. Okay, so let me conclude by saying what we're trying to do: construct new theories on the distribution of pre-tax and post-tax income consistent with macroeconomic totals. We hope you should see all of these as kind of prototype theories. The hope is that they will be adopted by government agencies down the road. And for the US, the key results to remember, the most striking results from that exercise is that the income for the bottom 50% has stagnated since 1980. For the working age population, it actually has declined. The boom in the rise in inequality at the top used to be a labor phenomenon driven by labor income in the 1980s, 1990s, but now is a capital income phenomenon. I didn't have the time to talk about the gender gap, but what we see is that it has declined, but it is still very, very large at the top today, with basically only, among the top 0.1% income earners, still 90% are men, 10% are women. And the government has offset only a small fraction of the rise in pre-tax inequality due to the fact that U.S. transfers actually are not very progressive, and that tax progressivity has declined since 1980. Thank you very much.
So we have time for a couple questions. Back there.
Thank you. Very interesting presentation. The figure that where you show the distribution of incomes across percentiles pre and post tax, I was curious. Have you looked at it with a narrower window, say 2 years? Is it much more noisier thinking in terms of having that same figure as a way of monitoring things going forward?
Yeah, well, over short periods of time, growth is very volatile, including macroeconomic growth. In 1 year it can be 3%, the next can be 0, and so in the very short run, things are noisy. If you want to understand what's going on, you have to look at 10, 15, 20, 25 years. In that case, it would not make much of a difference whether you start in 85, for instance, or in 1980. It would not make much of a difference whether you ended in 2018 versus 2014.
Brett?
May I momentarily shill for Big Pharma and for the American Medical Association by saying that I'm not sure it's completely fair to dismiss the expansion in healthcare expending for the old and the poor and the disabled by saying that it mostly goes to the pockets of the medical industrial complex and contributes to paying our specialists 3 times what they're paid anyplace else. That yes, the kind of fair value of medical care services actually received by Medicare and Medicaid beneficiaries is probably something like 1/3 of the federal expenditures. But those expenditures are worth an enormous amount in utility terms to many of those who get them, and also to an extremely large amount in terms of mental health and lack of worry and security terms to people ex ante who know that they actually are qualified for insurance. And in some ways, this is simply the tip of the iceberg, that we are all trained professionals in this. And yet we attempt to evaluate the effects of the social insurance programs on the distribution of income and wealth by slinging money metric numbers across and trying to form cash equivalents for all kinds of things. And maybe this is totally inadequate. Maybe we should just revert to our utilitarian fundamentalist roots and make bold assumptions about utility as a function of income, wealth, and health status, and actually calculate explicit util distributions across the population. The rest of the world might not understand us at all, but at least we would understand ourselves, which I don't think we quite do now.
Yeah, no, I agree. I was being a bit provocative. I was taking seriously, what Peter said this morning, which is, if healthcare spending was 4 or 5 points of GDP lower, maybe, we could keep health outcomes the same. And let's take that seriously. And you reduce by 4 to 5 points, and then you compute the top line with this reduced healthcare spending. And a lot of it corresponds to spending, is absorbed by Medicare and Medicaid. And so you could have, a stagnating bottom 50% post-tax income with exactly the same health outcomes, which another way to rephrase that is that this extra spending that we see here has not benefited in any meaningful sense those who nominally receive the transfers, but it has benefited other groups of the population, whether these are the pharmaceutical firms or the doctors or other people in the health sector. That I don't know. Thank you very much.
Thank you. That, we're just about out of time, and that concludes our program. I want to thank you, those of you who are here for coming, and I hope that this set of presentations today gives you a sense of both the importance and complexity of the issue of economic and inequality, and more broadly inequality and well-being, and also the ways in which economic research is engaging with these important questions. I think it's clear both that much research is going on, and also that there are many important research questions still in need of being addressed. But at least you can see that we've made a start. So thank you all for coming, and this concludes our program.